Hey everybody, Donnie Turner here. This is part 2 of our first series of the beginnings of Chase Clark and Peter Murphy's journey through real estate. If you're listening to this now, thank you for coming along for the ride and tuning into the second episode. There's a lot more to come. So if you're interested in this kind of content, if this type of stuff engrosses you and you want to learn more in the future, we're going to be talking about all kinds of different ideas about investing in real estate. So make sure to stay tuned. Subscribe, leave a review, tell all your friends. It'd be much appreciated. Now, onto the show. Okay, so we saw, the calamity that was the 2008 recession and the collapse of the housing market. This is 2008, 2009, where everything goes down. So, where are you guys then and there? What happens to that? What happens after that?
Well, we're shell-shocked too. I mean, everyone who's been recently in this housing market, who just joined it, which we were one of those people, had not seen this before, right? So we were devastated and we were picking up the personal pieces of our lives and trying to cobble it back together. But there were a lot of people that had seen it before. And these were people probably who were in there at this time, early 50s and sick and older. These were people who had experienced the crash of the housing market in the 1980s and the RTC crisis and the savings and loan crisis. And those guys, it's like they were genius in a sense. I mean, they'd experienced it, so they saw it coming. And what I think they did that many people did not do, and we call them mom and pop investors, because these were like the millionaires next door that we've read about, right? They liquidated some of their real estate prior to the housing market reaching its peak. They saw their handwriting on the wall that things were going to go south because they had experienced it. They sold a bunch of stuff. They socked money away in cash, savings accounts and CDs, so that when prices plummeted to the point where they were bumping along in the bottom, they were able to start picking up the pieces in a really aggressive way. And so we saw mom and pop investors just flood into the scene here locally and start buying up real estate at $20,000 and $30,000 and $40,000. I mean, literally, we were buying real estate at that. People were buying real estate at that at those prices.
Yeah, it's kind of interesting because market. We saw the market on its way down in 2007. By 2008, it had completely crashed, but it wasn't immediately that we saw this rush of money, and the government didn't know what to do. A lot of people kind of waited around to see, well, what's going to happen here? I mean, we were in the midst of a beginning of a recession that was going to last for, probably 10 years almost. We had, uncertainty all over the place with the stock market, with housing and all that. But there were some people out there that could tap into money. And so they did start buying it. Probably bought in earnest around 2009 and 2010 is when, the uptick really started to happen. You started to see the cratering of housing prices. I think in 2009 is what we finally saw when they finally hit the bottom and then started rising on the way back up there later in 10, 11, 12. So it was interesting to see how that curve happened.
I mean, do you remember seeing the $19,000 condo? I mean, these things were completely boarded up. Their toilets were gone. The people who had, the investors who had bought them, stripped them of everything they had. But there were opportunities to buy condos in communities that are now selling at $170,000 and $180,000 for $19,000. I mean, it was just bargain basement prices. And, we all looked at it at $19,000 and said, too expensive. We shouldn't buy it. The market's in shambles. Don't buy it. Don't touch it. It was crazy times.
Well, I'm glad we're talking about this now, especially now, because, a lot of people are arguing we're sort of entering into a recessionary environment. And I guess in my case, me being a millennial and, especially Gen Z and so forth, I mean, these two generations, you can argue that we haven't really seen a recession before. You guys, I guess you guys saw, there's the 2000 internet crash, right?
Yeah.
So you guys saw that. I mean, you saw what a recession looks like. But then, yeah, I mean, there was that paradigm of that housing only goes up, but then that crashed down. But I'm trying to equate that with what's happening right now. I mean, we just see with the recent rise of interest rates and but housing is still sort of doing okay. I mean, what do you guys think about that?
Well, it's interesting because I
kinda-
think there was still, like, I'll call it PTSD from the housing crash. I'd say the vast majority, I'd say very few people knew this was coming. We know that because there were very few actors that took a hedge against this. You watch stuff like The Big Short and movies like that where, you see the type of person that really predicted this crash coming. A lot of people that were in the housing market at that time had just come out of the dot-com bust, 8 years earlier. And so having gone through a bust in 2000 and then, trying to recover, and then all of a sudden this huge wave, which was a bigger hit than the dot-coms, comes at people. And not only does it hit them in their real estate values, it hits them in their jobs, it hits them in the stock market. I mean, it was a pretty all-encompassing financial crisis for the country. And people had a hard time digging out of that mentally, I think. And even still today, looking at how much you overexpose yourself in one arena with what you invest in, whether it be real estate or the stock market or anything else, if you went through that experience in 08, you can't help but think that your strategy is a little bit tempered by the idea that something could come along, something similar to like what we just went through with COVID, could come along out of the blue from nowhere that no one predicted would happen, and you could be hit with a 30, 40, 50% loss of your assets that's completely out of your control. And so I think a lot of that experience going through tough times like that, at least for me, has put me in a little bit more of a conservative mindset when it comes to how I deploy capital, and making sure that we take the right steps to mitigate some of these potential issues if they were to arise.
Well, Peter, you mentioned the old timers back then, right? The mom and pop guys, and they sort of knew when to liquidate, right? They had the dry powder, they had the money in the bank and the CDs because credit lines dried up, right?
Right.
I mean, if you had a HELOC, that didn't really mean anything. If you were pre-approved, that meant nothing because the banks weren't lending any money. So it was only the guys with the cold hard cash that could move, right?
That's exactly right, and they did move, right? And they were the ones who first moved into the market in a meaningful way and began to buy up that bargain basement deal, right? And they put a lot of the sweat equity into it. And they were local, and they were able to kind of figure out the local dynamics and understand what was a really good deal and what wasn't. And they really set the stage for the institutional surge. That's like all the big movement of the iBuyers and of the Progress Residentials and the Invitation Homes, these big institutional buyers that have flooded into the markets over the last 15 years or so. Well, goodness, less than 15. It's 10 now. They set the stage for that. They tested the market and kind of like sucked up a lot of that really low-hanging fruit. But they did that because, like you said, they had the liquidity and they were ready for it. And so now we have people who hopefully are doing the same thing, right? And I say hopefully because, strong markets, bull markets don't last forever. There's always some manner of correction. And so we want some diversity in our marketplace. We want some people to be liquidating some of what they have because there will be corrections, and those people, when those corrections will happen, those prices come down, they'll be able to swoop in now, right, and help clean up some of the mess. It's like, the vulture is needed within the ecosystem of any environment because it helps clean up disease, right? And bones would have meat and disease on them still, and they pick them clean. And they do a really valuable service to the environment, right? So I'm not calling all mom and pop investors vultures, right? But you get the idea. They did something really, really good, tested the market, and helped clean it up. And they were ready. So, to some degree, Chase and I are doing some of that too. And most investors that we know right now are trying to retrench just a little bit, sell opportunistically, so that if there is correction, or a slowdown to the price escalations that we've seen, we'll be ready for it. We're not putting our money on market failure. We think there's some real differences in the market today than there was 10 years ago that would make this kind of destruction a little less likely. But it doesn't mean that something completely unbeknownst to us, like Chase just said, something none of us know about or none of us can foresee, might not hit us and blindside us. And then someone will be needed to step in and fix things temporarily, right? So maybe that's some of us. Maybe we'll be the vultures. You're going to be the vulture, Chase. I'm going to be the nice guy.
vultures do a very important job in the ecosystem of cleaning up the bacteria and cleaning things out. You know? So it's a service, like a community service that real estate investors can provide to the marketplace when needed.
We just need publicists to rebrand us as not vultures.
You know who's usually providing the carnage, though, is the government. I mean, like, one of the interesting things is in the housing crisis in '08, that these houses were on the foreclosure steps. You weren't buying foreclosures. You were buying these homes directly from banks that owned them. I mean, they had taken them back, but they had taken them back because banks had been forced by the government to come in and clean up their balance sheets. They'd been bailed out, so they didn't have to get a dollar-for-dollar return on these notes they were holding. And the bank gave them an edict to go in here and clean the balance sheet, and that's what they did. And that's why we bought a $19,000 condo and a $30,000 condo and a $50,000 house and so on and so forth, when we all knew that the market was extremely undervalued and only going up from there. Tremendous opportunity, probably a once-in-a-lifetime opportunity.
And to speak on that point, the reality is you being the investor and buying it for $19,000, you're taking the risk.
Yep.
And you're repurposing that asset that wasn't doing anything. You're rehabbing it, you're facing it up, and then you're putting it back on the market and turning it back into affordable housing instead of it just being a vacant lot. So, I mean, you could say that's vulture investing, or you could say you're repurposing a useless asset, turning it into affordable housing, and allowing people to live in it again, right?
We'll be back after a quick break.
You hear a lot about supply chains these days, because if the past couple years have taught us anything, it's that an efficient, well-managed supply chain is absolutely critical to keeping businesses successful and consumers happy. I'm Will Haywood, and I host a podcast called All Business, No Boundaries, where we talk about supply chains, how they work, what happens when they don't, and the innovations that are redefining what's possible in the world of logistics. Listen and subscribe wherever you get your podcasts.
Yeah, you know, the interesting thing, too, that I remember going back to the, '08 through '10 years is that we were dealing with tons of California investors. We were dealing with tons of Europeans. So it's interesting that the people that had the money were in California and Europe, primarily. There was the rise of these investment clubs that came along. And so lots of real estate, former real estate investors who maybe lost their shirts pivoted into education and club forming, where they were going to gather other investors together who hadn't lost their shirt. A lot of these guys were first time into the real estate investing arena, but now they were being educated by people who kind of knew what they were talking about because they just lost their shirt and had some success doing it previously. And so you had lots of new money coming into the market, which created new investors, and they were automatically set up for success. When you're buying something at a 12 or a 14 cap rate, it's how can you lose? Hardly, as long as you've got a good management strategy or you've got a good property manager. And that's one of the things that we saw during that time was that our property management business that we had started back in 2008 started blowing up because a lot of these non-local guys were buying up a lot of this property. We had made connections with some of these investment clubs across the country, some in Europe. And so investors were flooding into the area and they needed our services. And that was a huge boon for us in the property management realm. And kind of was what helped jumpstart our rise in property management.
I'm thinking back to a lot of those conversations we had with those early stage investors and what Europeans and Californians, right? When they saw home prices at these lows, which is what they were in Florida and, also in Arizona and, certain other markets throughout the country, first of all, they believed in U.S. housing. I mean, truly, they were believers, right? Especially the Europeans. They're like, you guys have an economy of 300 million people. There's no way you guys aren't going to fix this. You're not going to clean this up because that's what Americans do. We fix messy situations and we make them prosperous and profitable. And so it was great to hear that kind of faith in us. But also, you found West Coast people and European people just like shocked by the low prices because they knew fundamentally that a piece of real estate with improvements on it is not worth $20,000. It's worth well more than that. The market was giving away real estate at prices well below, by any measure, actual value. Now, they were damaged and they were ugly and they stunk. I mean, because they'd been vacant for so long. But there was no way that you could look at that and say, this is what this is going to be worth a year from now, right? You looked at this and said, like, this is a giveaway. It's just that I don't have the cash to buy it because all my cash is tied up in other real estate, right? The guys with the cash to buy it saw that, took advantage of it, believed that better times were ahead, and boy, were they right.
Yeah, I mean, you're talking like properties at $30 to $40 a square, well below replacement costs or construction costs at the time. And in addition to that, too, you got to think this was a global crisis. This wasn't just something that hit the U.S. This hit the entire world. And in that regard, I do remember many of the Europeans coming and saying, anytime we have a global recession or a global crisis, we want to park our money in the U.S. Our faith is in the dollar, and we know the dollar will recover first and will perform the best out of any other currency or any other economy in the world. And that's a really reassuring thing to think about. And it, just goes to show you what the attitude is or the perspective is on real estate and the dollar and the economy and everything else we have going for us in this country, and how fortunate we are to be able to invest in tangible assets like real estate here in this country.
Yeah, but it took a few years before Americans joined en masse, joined the ranks of the believers, because mom and pops did a great service, and we grew our property management business for a few years on them, probably up to about 1,500 or so doors. We became dominant in Tampa Bay on mom and pop investors before institutional business moved into the market. And institutional business moved in that like 2011 and 2012 time period, and they already saw the handwriting on the wall, and that was that things were going to look up. And this is a market of huge opportunity, and the government is seeking huge bailout funds to fix this dilemma, and they were able to take advantage of really low buy prices. And we were able to grow our business even to really to the next level on this institutional surge. And that's who the iBuyers are now, really. But to some extent, the iBuyers are an evolution of this because the institutional guys bought up a ton of stuff. The iBuyers are now institutional buying models in a more commercialized form. And this, over the last 10 years, has become very formal and very much a part of our economy. But that's what HomeProp is, what Chase and I developed our businesses on as we grew from that mom and pop servicer to an institutional servicer.
Well, so back when I started investing in like 2016 or so feel kind of late in this conversation, but that's okay. I remember Warren Buffett saying, and he's often kind of late, but when he speaks, he's usually pretty right. He was like, yeah, there's incredible opportunity in the single-family home space, single-family rentals, if you can manage them, right? And that harkened to all that institutional money flooding into the market. And, a lot of people looking at single-family rentals like, okay, this is an investment class. But, yeah, pre that, what was it? How did you guys, you mentioned that you had 1,500 doors under management. How did you guys do that in the midst of a recession while working with mom and pops?
Well, because of exactly what you just said. It's because everyone recognized that management was the dilemma. The technologies weren't there to make management an efficient process at the time. And management, for those of our listeners who don't really know, that's the collecting of rents, the managing of maintenance, the handling of all the legal issues related to the actual tenancy at a property. It's very complicated, very dirty business, and the proficiency wasn't there in the market to do that at scale. So our company was one of the first to make a really good shot at putting together a scaled up and multi-market property management opportunity. That's largely owing to Chase and I and the team we put together that just did operations really well, right? And we educated the institutional players who came into this market. They had all the money to buy houses, but they were clueless on how to manage those houses. They hired our firm and firms like ours to teach them that. And that's where Warren Buffett became somewhat of a prophet, because they used local expertise. We were happy to sell that service to them for a time. They used that to gain the chops in property management. And now most of them have their own developed property management structures to manage their tens of thousands of units.
Yeah, so, one thing to remember, too, about this is that institutional money, specifically Wall Street money, moves very slowly. And so there was a 5-year proof of concept before any Wall Street money really came to the table. 2012, 2013, kind of the beginning of like true Wall Street money. But what they needed was proof of concept. And so one thing we were able to tap into early on were these, we'll call them small institutional players who, family office funds, people like that, small corporations that came in, and maybe they were going to buy up, $20-30 million worth of product. Versus when Wall Street came to town, they were buying up $300 million worth of product. And the proof of concept came from these smaller guys. It started with the mom and pops, like we've talked about. Then it kind of graduated into these small, then mid-sized institutionals, and then Wall Street hits the scene with, the inception of Invitation Homes and Blackstone coming in, and doing that huge investment they did up front before the likes of Colony and Progress and these other guys came along, all backed by Wall Street money that was now convinced that they had proof of concept to go in, all the while still using local expertise, which again, as we already said with Buffett and other people commented on the idea that, look, you've got to have good management. Management is the key to the cash flow.
Yeah.
And that's the service we were able to provide in the local market because we knew how to scale a business. We hadn't done it before, and we were kind of figuring it out, but it was something that few other people were figuring out at the time, is how to scale a property management business. We're talking about a very fragmented industry in most local markets. You may have a couple hundred property managers here in Tampa Bay, all managing like 100, 200, 300 units, maybe at the most. And the ability to get from there to several thousand units is a whole different mindset, a whole different organizational structure, and something we were capable of taking off the ground.
Yeah, so that's how it is now, right? Very heavily fragmented. It's a proven business model. But when you guys first started, that wasn't the case, right? It was not a very popular business. People thought the margins were too slim, or even unable to be made profitable, right?
Right. Yeah. No one saw the opportunity in property management. They had very myopic points of view as for where the flows of revenue would come from inside the sector. They were never able to scale up more than 100 units, and so they were doing all the work themselves. They couldn't hire the staff to make it work. And those were all things that we, groups like ours, determined. And there were several movers similar to us at that time who were able to put together large-scaled operations. And usually there were people with analytic backgrounds, with some brokerage backgrounds, who were investors themselves to some degree. And what was often the case was that they had some organizational and operational expertise from past industries. And that we had come into real estate at just the right time. It was so interesting, Chase. I mean, we remember, there was a whole group of people who kind of, quit their corporate jobs. We talked about this in our first episode. They quit their corporate jobs at the turn of, just after the dot-com crash and right after 9/11 because they wanted the freedoms that real estate offered. And they had that little bit of experience from professional circles. They brought that to the housing sector. And then they were all at this stage of their careers when the housing market crashed. And so I think a lot of people just like us brought that little bit of experience and were able to create property management in a big way. Whereas a lot of realtors who had kind of always been realtors, they didn't have the same background that we had. And they weren't able to do what we did as a result. So another great example of timing, right? Timing is kind of everything. But there were several people who did what we did all throughout the country. Yeah. So much so, in fact, that Wall Street came knocking in a different way. So all this growth happened in the institutional sector. It built our businesses. We all built very large-scaled operations around key markets in the U.S. And then Wall Street was like, hey, we need a national property management system that can be sold not only to institutional players, but that can be scaled up across the country. Mm-hmm. And really, that is kind of the next stage of evolution in our company, is that venture capitalists and private equity groups came to us and said, would you be interested in participating in a roll-up of property management companies to create a national property management system? So that was, somewhere around 2015 to 2016 where those conversations happened in earnest. There were several of them. But in 2016, Good Friday of 2016, Chase and I sold our first property management company. After buying quite a few during that period to kind of roll them up ourselves, we sold our first property management company, which was Home Encounter, and rolled it up with several other purchases, which is 3 other purchases at a time, to create a national property management framework. And that brand is now known as Home River. So we were founding partners of that organization.
Yeah, it was interesting because interest that started being developed in companies like ours by some of these big players came out of their need for what they thought they needed to do with internalizing their management systems. We had managed as a third party for two of these big institutional players for several years and done it extremely effectively. And when they came to us and said, hey, we're going to start internalizing our property management service, we were looking at the numbers thinking, well, how can you do any cheaper than we're doing it for you? We're a mid-sized player. We're agile. We're able to meet all your needs. We're able to expand with you and contract when needed. We're able to provide, multiple types of services for you. And being that way for them in this local market, actually what turned into the entire state of Florida by 2015 was our continued growth with Progress Residential through 2015 led us into 5 offices throughout the state of Florida with over 6,000 units at the end under management, with people providing all types of property management and asset stabilization and asset management services, as well as HOA management across all those markets throughout the state of Florida. And because of that, because of us being able to grow the business alongside some of these institutional players to that type of scale, it made us a very attractive target for someone to come in and roll us up, like what Peter mentioned happened finally in 2016. But because of our scale and because we were in a state like Florida, which was a hot market, I think between Florida and Arizona were like the 2 hottest markets at the time, and made us a very attractive player for someone to target. We started getting unsolicited offers, to buy our business, and several of them in 2015. And it was funny because I think right around the time that we were done entertaining offers,
Always.
we get a call and they say, name your price. And so we throw a price out there and they're like, okay, let's talk about it.
Right.
Oh, wow.
Yeah.
Probably should have said more then, huh?
You never know, Well, I think what we learned during the process was it didn't matter what we said was the price. We were going to eventually arrive at the price they wanted to pay.
Yeah, that's right. It was a fascinating process to sell a business. I mean, lots of fun, really interesting. The courtship rituals surrounding VC and PE firms are elaborate, and dramatic and very drawn out. I think I've heard said that some of these things happen faster, but ours was about like a year-long diligence process where we kind of every orifice of our corporate body was carefully inspected, and we asked all the questions that we need to ask and feel comfortable about where the future was going, because some of these groups wanted us to stay with the businesses. I mean, again, we had experience doing what no one else in the country was really doing at this scale, so they were interested in having us stay around in the management capacity, which, by the way, is tangentially, you hear all the time. People say, sell your company and don't stay around, because there's some challenges that ensue. The entrepreneurs sometimes don't always mix all that well with their new buying and management entities, and there's a variety of reasons for that. But in our particular structure, we committed to staying around for a couple of years, and so after we sold our business on Good Friday, Chase, happy anniversary, almost.
Coming up.
Very soon. We sold it Good Friday of 2016, so we're 6 years past the date of sale.
I think it was March 26th that year.
It was earlier. That's right. It was a March date. We signed off, money hit the bank account, and we had sold our business. And we had committed for 2 years to work with the new ownership entity. And so we began 2 years of very difficult, challenging, rewarding work, because we were trying to pull together multiple different companies, set a vision, build a national brand, fight all the kind of battles that you've got to fight when you're doing that, both with your funding partners and your peer companies. And boy, was that an interesting exercise, rewarding exercise in lots of ways. And it lasted 2 years.
Well, yeah. Before we get into that sounds fascinating. But 2 questions. So one, what really motivated the idea to sell? I mean, it sounded like you guys had plenty of momentum by yourselves. You guys were growing at a rapid pace. What was it? Purely the fact that they said name your price? And the other question was it hard to make that decision? I know a lot of people, when they they give birth to these companies and they raise them, and then they're almost quite literally their baby, and it becomes an emotional decision. Like, I don't want to sell. I've spent, so many years, blood, sweat, and tears. I've hired everybody. I've trained everybody. It's just all this stuff. I don't want to sell. So that's just what I've observed in other business owners. So how did you guys go through all that?
Yeah, there was a lot of all the things you just mentioned going on at that time. It was a very tough decision, I think, to sell. But at the end of the day, it came down to numbers. I think what we perceived was happening at the time was that we got an indication late in 2015 that Progress would be internalizing their management services as well. And there was a little bit of runway on that for us. I don't think they ended up doing that until about the end of 16. But we knew that was going to happen. And at the time, I think that was a little bit over 50% of our business was coming from institutional clients that were potentially going away. So we knew we had that on the horizon. But there was also this exuberance around residential property management at the time. All the institutional players were internalizing and then talking about the potential of offering that service in addition to the portfolio they own, going out and trying to attract other property management clients and trying to grow it from an institutional level. And we kind of saw some of that handwriting on the wall of where we thought the industry was going. By this time, too, in 16, 17, 18, you're talking about housing prices are ticking up. We're seeing less mom-and-pop entrance at this time into the market as investors. So knowing that we got to go back to a base of mom-and-pop clients, and there's fewer of them coming in because the cap rates are going down as prices rise, rents yet hadn't caught up with the housing value increases. We looked at the offer that was on the table, which happened to be at the time and said, we're probably crazy if we don't sell for this number right now. And so once we crunched the numbers, had some conversations, not only just Peter and I, we had a minority partner at the time that ran our HOA division, and talked through the numbers, looked at it, and decided that we were probably going to be able to sell the business at the peak of its value, and decided that was the right thing to do.
Yeah, and whether or not that is true, that's kind of the math you use when you're going through these kinds of decisions, right? Maybe there was more of a runway of growth. Maybe we were going to have a temporary adjustment of a loss of institutional revenue, but a resurgence of some other kind. We were resourceful and nimble people, so we're not going to just sit around and let things crash. We would have made it better, and we were young and full of energy, and so a lot of thought went into it might not be the right time to sell. But just like an investment property, if you're an investor, you own an investment property, and you do all kinds of math to determine when the right time to sell that house is, right? It's not own it forever. There's all kinds of reasons why you don't own something forever, and one of them is just the fact that cash today that you can use for alternative uses, it can be far more attractive, could produce at a higher rate for you than cash 5 years from now that you're going to get 5 years from now. And so we knew that we would preserve and grow our company, but there was going to be a cash event when we sold our company that would allow us to do some alternative investing and just kind of grow our own portfolios that we felt like by taking advantage of right now, we would yield better in the long term. And so we did that analysis. At the end of the day, it all worked out that making a sale decision now at this price would make sense for us and we should do it. But yes, it is painful. This is your baby. And you put so much blood, sweat, and tears into it, and you're going to hand over the keys now to someone who doesn't love it the way you do, and doesn't love the people the way that you loved them, and didn't, kind of make allowances for everyone's strengths and weaknesses the way you did, and provide for their families. All this kind of, all this soft stuff that's a part of why we built the business to begin with was going to be taken out of our control to some extent. So very difficult decisions, all of that. At the end of the day, we felt like we were going to be with the company for a couple of years. We could still influence and control and change some things for the better. And so we dug in that kind of a way and took some cash off the table at the same time. And I think on the net, it worked out pretty well.
Yeah, and these PE firms are smart. They come into guys like us, and they got a great pitch for us. It's like, hey, be a part of something bigger. You're going to be a part of a roll-up, a nationwide roll-up, and we're going to do all these great things, and we're going to take what you're doing now and 10x it, and you're going to be a part of that. and the rising tide's going to lift all boats, and everyone's going to get rich, and all this stuff. And in some ways, we bought into that a little bit. We were excited about that, idea, along with, taking some cash off the table. I think we quickly found out that, the honeymoon was over relatively quickly. And even though we all tried to make that, that 10x leap with the nationwide company, it's just not an easy thing to do. Trying to meld 3 companies into one, taking different personalities, different strategies from, shops that are all over the country and trying to get some kind of uniform general way of managing properties. I think we quickly figured out that's just not ideal sometimes. Florida doesn't manage like Idaho, like Indiana. It just doesn't always work that way.
And there's software differences. There's big questions on software consolidations and conversions and lots of things that are different in terms of how companies operate, which make marrying 2 companies challenging. And the M&A sector knows this very well. We just didn't as much. We can be very optimistic as entrepreneurs. And it'll be fine. You'll get right through it. And, you always have in the past. But some things are not as easy to get through. And you burn a lot of political capital doing that, right? You fight a lot of fights that are important to you. And that doesn't always land you on the right side of people's, opinions or impressions of you. It doesn't always what's best for relationships within the organization. But you fight for what you believe in, right? And you spend the political capital on things that are important to you. And at the end of our relationship with them, it was a 2-year contract we had. I think that came as a somewhat of a surprise ending to us. We both felt like our organization was on good footing and growing in a good way, and we wanted to stay with it for a while. We would have liked to have been a key part of the growth of the company. And so although we're still shareholders of that organization, that didn't work out quite that way. And all things happen for a reason. In retrospect, we can be very happy that it worked out that way. But, you pour so much of yourself into something. You want it to succeed by your vision of what success looks like. And I think our vision of success was us involved in that right through the end, right through whatever the end looked like, and that didn't happen. And so, 2018 or so, our relationship ended with that group of people. Lots of sad goodbyes, and because we weren't ready for it entirely. I guess you could look upon that as a pretty big setback. We had a big financial setback, about 10 years earlier. And now we were having, I think, what could be defined as a pretty big career setback by like a change in courses in 2018. And we've had to learn from that. I think we learned a lot of really good things from it.
Yeah, really probably the only difference was 10 years earlier we were actually broke, and now we just sold a very valuable business, which allowed us to then turn around and redeploy capital and use some of the methods and strategies we learned over the last 10 years to do so. And that was kind of fun to be able to be in that position now and not, having to worry necessarily week to week about having to make a paycheck. Mm-hmm. But as Peter mentioned before, it was interesting because the housing crash came out of nowhere. In some ways, this career change hit us a little bit by surprise because we viewed ourselves as pretty integral to the Florida operation that they had. And so learning how to pivot on that change and come up with, something new to do. And the discussions around that we had about, well, what do we do now? Do we go back into real estate? Do we try and recreate what we had? Do we go into a different industry, different sector? Do we explore this? Do we take advantage of this opportunity or pursue that? Those are all tough questions, when you're at this kind of turning point in your life. And you do have options. But ultimately, we kind of, migrated back into what we knew and created HomeProp in 2018. Had a non-compete, so we sat out of the PM side for another year until we could get going with that. But we tried to create another real estate services firm similar to what we had done with Home Encounter back in 2008, I guess. And, we're off to a good start, but totally different time, totally different look, totally different feel, and totally different market, which is probably one of the most influential factors in real estate services. What's the market doing? Is it right for investors? are we in a PM growth cycle? Are we in a stabilization cycle? Or are we in a disposition cycle? And we've been in a disposition cycle now for the past, 3 or 4 years as far as investment property goes. Even getting more and more of that direction now as prices have gone, where they've gone over the past 2 years, really hitting 35% growth a year in this market.
So we're seeing fewer and fewer mom and pops trying to enter into this market, you think?
Right now, yeah. The cost of entry is so high. Mm-hmm. I mean, even when you're looking at an average home price of $425,000, you're putting 30% down. You've got to bring $130,000 at closing just to buy the average single-family home.
Yeah.
And interest rates are on the rise, which means cost of ownership is going to be higher. Insurance is going up. Property taxes are going up. And rents are going up. But, there's a ceiling on that, I think, that will depend on what the affordability level here is in this market.
Chase, I gotta go back to some of what you were saying about the transition from our old employer. Because while you were talking, I was looking back to my photo album and I found the picture of you and me sitting outside Starbucks the day the hammer dropped. Right?
Oh, I remember that.
Like, here it is. We should post it online along with this podcast.
Yeah.
Like, here we are, right? And like, you walk out that door and you're like, oh goodness, what now, right? Because things don't go according to your plans. I mean, like, that has to be one of the most important lessons every real estate investor needs to know. Every person needs to know. You can have the best made plans in the world, and all of a sudden the rug gets pulled out from under you, and oh crap, now what, right? And that's a really important moment. It's one of those tipping points in your life where you can like get angry, you can get blustery, you can fight, you can spend all kinds of negative energy dealing with all the emotions that you have. And, it's probably good to do some of that, right? But pretty quickly, you've got to pull the pieces together. You've got to get back up. You've got to use what resources you now have. You got to start charting your course again. And you got to, figure out, too, who you are. Because, you're defined a lot of times. A guy certainly is, I think any professional finds themselves any person, right, finds themselves defined by what they do, right? You are the runner, you are the real estate guy, you are whatever, right? And all of a sudden, if you're not that guy anymore because that job is gone, then, well, who are you exactly? And so we spent a lot of time wrangling with that. And it was one of the most awesome times of recreation in my life. Once I look back over the last few years, the things Chase and I have personally gotten into over the last, 5 or 6 years are awesome. I mean, we each have invested in almost this Cain and Abel style of agricultural strategy, where Chase is a little bit of a livestock guy, and I'm a little bit of a crop guy.
I promise I won't kill you.
And yeah, please. Wait, it's the other way around.
Oh, yeah, it's the other way around. I promise I won't kill you.
At least not today, right? Am I my brother's keeper? I don't know.
Yes.
No, but so that was one thing what came of all of this. Chase and I immersed ourselves deeply into different kind of athletic pursuits. Some of those kind of overlapped. We went on some fun bike trips together. I started running. Chase started biking, We started spending a lot more time with our families at some of their events, right? Where family's always important to us. We said we got home in time for dinner, right? Every night. But now we're able to coach some of their teams at school and volunteer at their field trips and teach their vacation Bible schools at church and things like that kind of have all been allowed to us by virtue of real estate. So things that have happened over the last 2 years, totally different from where they were, when we first sold, but so much more rewarding in lots of ways.
Yeah, and I think sometimes it takes a little bit of time for that stuff to unfold, because back in 2018, we were scrambling a little bit, like you said, trying to find an identity, all this uncertainty again. People hate uncertainty. Mm-hmm. I hate uncertainty. I like to know what's going on. I like to know what I'm going to do the next day. I like to know where I'm going, 3-5 years from now. And we didn't have any of that. But in hindsight, now looking back, 4, almost 5 years removed, and going back to your question of, was it the right thing to do to sell the business? 100% at this point. I look back and say yes, because of all the things Peter just said. If we were still running Home Encounter today, we couldn't do half the things that he mentioned. The deep returns that we've received from more family time, more involvement with our kids, more flexibility with church activities and things like that. You can't put a price on some of that stuff. And to be able to do that in our early 40s is a gift, I think, from God that a lot of people don't get to experience when your kids are at a young age. Most people end up retiring when their kids are gone, and then it's hard to get those experiences back. And we've been richly blessed with that opportunity to experience that while our kids are in elementary, middle, and high school now, and to pursue things like farming, where we are able to give our kids and our families these rich experiences and show them, the way that God's creation works without needing to really make any money from it, but just for the true experience of being able to see it firsthand and to work hard and to till the ground and to raise up the livestock and to show them God's plan for things on this earth. It's just been truly rewarding.
Amen. I'm glad that you said that. I think everything that you described that's real wealth. Yeah. I mean, having the freedom of time, having the freedom to be able to be with your family. You could be incredibly financially rich, but if you're succumb to the idea of just making the numbers in your bank account bigger over spending time with your family, which I feel like, isn't that just the common narrative? That's so many guys fall into that idea. Yeah. But it seems like maybe it was God's providence that happened, and kind of got snatched out of that lifestyle.
I think so. And it's not like it was like all that natural either. In the sense that we fought some of this, right? Between 2018 and now, there's been many opportunities that we've had to say, hey, is this kind of what we want? We've got a lot of professional involvement, professionalism that we can extend to the market. We can get back involved in companies again. We have had job offers, solicitations for that kind of thing to re-immerse ourselves in other organizations. And so it is tempting. But one of the things that we've recognized is, we did what a lot of guys or a lot of ladies might find that they can do too. What is it that you really need in order to live, right? And can you moderate your lifestyle slightly so that you can spend your time on the things that are the most important? And so we sold a company, and so that gave us a little bit more resources, but you don't need anywhere close to that to cut back your commitment to work and ramp up your commitment to your value systems, your families, your churches. And so that's been one of those things that we've tried to be, proclaimers of. Take advantage of wherever you are in life. Give yourself the true wealth of time and control of your time, and don't re-enslave yourselves if you don't have to, right? Mm-hmm. Which is kind of a lot of what a corporate job can do to you. It can kind of enslave you to the man. So, we did a lot in this country to overcome slavery. Don't re-enslave yourself again, right, to something you don't have to. But at the same time, right, our family is constrained, right? Our families go to schools. Our wives want to be involved in their schools. We would love to just kind of load everyone into an RV and go, but there's practical considerations that we can't just do that all the time, like our farms, right? And our relationships and our churches and things that we're involved in. And so, people ask us all the time, why do we start HomeProp again then, right? If we didn't really need to. And part of it's because, of that, because, we still have something to offer to the marketplace. And this is kind of what this podcast is all about, right? I want to spend my time helping other people truly become enriched by real estate, and not just their bank accounts. That's a very important thing. I want you to have a large bank account, and I want you to do that for your family, and I want you to do that for charity, and I want you to do that for your churches and for this country, because the country needs your tax dollars, right? We all need this, but I want you to have the control of your time, and I want you to invest your time in other people and things that for me have been highly rewarding. And so, I want to, help other people understand that in whatever way I can, and I want to build a company to continue that legacy, because I want our children to see how to do that, to have a good work ethic, and I want to be involved in other people's jobs in their lives too, and to create jobs for other people. So lots of great reasons to stay professionally engaged, even though we may not need to as much right now.
Yeah, what I go back to part of our mission statement at Home Encounter from day one was real estate done right. And one of the comments people make to me every now and then, which I'm extremely humbled by, is something along the lines of, it's so great to see your success in business because I've seen you do it the right way. Some of that is being home for dinner every night. Some of that is, the fact that, we grew a very successful company and were able to navigate a sale to a PE firm without compromising our moral principles, without having any kind of, scandal or accusations about leadership or any way that we ran our business. With what I feel like is a pretty good reputation among our former employers and partners and people that we've dealt with over the years. We haven't done this at other people's expense, if you will.
Mm-hmm.
We've tried to make the pie bigger everywhere we've gone for all the people around us, while it's been bigger for us too. And I think that's a message that I would hope to resound to anyone who starts to be successful in anything that they do, whether it's real estate, any business they start, is, don't compromise on your core values and your moral principles to get ahead. And remember that the people that you take advantage of and you throw under the bus at some point in your career are still going to be there when you might need them down the road. And the richest man in the world with the worst reputation is not going to have a very easy life.
Mm-hmm.
People will be coming after you. And so I think a lot of that I can't even take credit for. I'm not trying to take credit for it. It's just, being partners has been one of the most valuable things, I think, throughout this entire journey, is because we keep each other accountable. And we have wives that keep us individually accountable. And we have other peers and mentors that keep us accountable. And, it's part of being a Christian. It's part of being partners. It's part of being family. It's part of really taking an interest in the people that we work with and the people that work for us and our clients and trying to treat them the way we'd want to be treated. And you probably, you can't undersell those aspects of business, because that's where you truly create value.
I think it's so important to acknowledge for anyone who's thinking about getting into starting their own business, getting into real estate, that what Chase just said about partnership is key to our success. I mean, it's not just tangential. You're going to find that you're capable as an individual up to an extent. You have certain skills that you've developed. You've got certain innate gifts. They are not complete, and there's a whole lot more about life and people that you don't know, right? And so a good partnership really rounds you out as a person. It's why companies have boards of directors and advisors, because one CEO or one leadership team still has blind spots. And I have blind spots that Chase is excellent at accommodating for and overcoming, and he knows about them in advance, so we don't have to tell each other what our blind spots are anymore. At one point we probably did, but he knows where mine are and I know where his are, and together we're able to, I think, have a very nice rounded approach to what we do. But I will also say that you could have more than two partners, because Chase and I together have some blind spots, and so that's why our teams have been so important to us, the people that we employ and hire, because those guys help us, those girls, girls help us to really, accommodate, account for some of those weaknesses that we are going to bring to the table by virtue of who we are. So get a great partner, right? Find someone to invest in real estate with you. Whatever it is that they can bring, it's something that you don't have, and you need to honor that and make sure you find a place at the table for that, because it will make all the difference between great success and, I think, great failure in your life.
Yeah, I love that. Well, you guys, everything that I've heard, everything that you experienced, you guys are a testament to that. So that's great. Okay. Well, that was great. That was great to listen to, and I'm sure the listeners are going to enjoy it. And thank you just for sharing your story. And it's exciting to see where you guys are going to be headed. Just a really quick comment. We were talking about what true wealth is. And, I was looking at our mission statement here, and it's to build wealth in real estate, in Tampa Bay specific, because we are Tampa Bay guys. But, I was thinking a little bit, I had a little bit of an epiphany. I was looking at my balance sheet, I was looking at my properties and all of that, and I was looking at my net worth, and I was I was, feeling a little good about myself. I was like, oh yeah, man, these appreciated pretty well, and with the equity growth and all of that. And then I realized, I was like, net worth doesn't mean anything. I feel like that's how a lot of people measure wealth. But I was like, I mean, the next recession could come and that could get totally shattered. I was like, the only thing that matters, and we've talked about this before in previous episodes, is net cash flow. That's true wealth, right? Being able to have positive net cash flow to help you buy back your time and to give you the freedom, right? And I was thinking that's going to be my investment thesis: net cash flow, net cash flow. That's all I care about. Growing my means so that I can be able to buy back my time and be able to work optional like you guys, but having that work optional be able to apply myself in a more meaningful way, right? To my church, to my family, and to help others. So it's a huge encouragement to me to see that you guys are doing that. It makes it feel real to me, and I hope it feels real to the listener, because it is possible. I mean, just look at these guys. So
great stuff.
Thanks, Donnie. Appreciate it, man.
All right. Well,
now I hope that you were getting audio on that, because I just realized none of our microphones were powered up.
Oh no!
Oh man, that's fantastic.
Oh no!
This was not plugged in.
Hey there, it's Peter Murphy with Buying Tampa Bay. Are you an investor who has ever wanted to own real estate in Tampa Bay? Or do you currently have real estate and want to grow your portfolio, add a few new investment properties? Or maybe you just need some awesome property management to de-stress your life. Well, here's what I found. HomeProp is hands down the best real estate investment brokerage in Tampa Bay. And they can help you build wealth in real estate, which is right in line with our podcast's mission to build wealth in real estate. And not just wealth as in dollars and cents, but in the quality of your life, the quality of your community, and just enriching what exists around you. So you want to learn more? Click on the link to HomeProp in the podcast description and give them a shot.